Good afternoon, everybody, and a belated Happy New Year to you all. Thank you for joining us today. This is the first of a two-parter exploring the use of credit referencing data in local government, particularly with elections. Let me introduce our guest speakers that we have for you today. We have Colette Land from Experian and Victoria Oliver from Just. Colette, would you like to share a few words about introductions about yourself?
Yeah, sure. Thank you very much, Brad. It's great to be here. Hello, everybody. So I'm a senior consulting partner within Experian. I particularly specialise in telcos and utilities, but basically I spend a lot of my time out and about with telcos and utilities in particular, understanding some of their current challenges, which are many in light of the COVID pandemic, and understanding how best they can use data, analytics and software to improve lots of areas, but with a particular focus on collections. So it's great to be talking to you all today.
Thanks, Colette. I'm really looking forward to the presentation. It looks pretty interesting to me, at least. Victoria, please give us an introduction. You're on mute.
I thought our moderators might have helped me with that one. Good afternoon. I'm Vic Oliver. I'm from Just. I'm the Director of Client Development. I spent the last 19 years in debt recovery, mostly in debt collection agencies, using data to inform all our strategies and all our client strategies. So I'm looking forward to going through the presentation today.
Great, thank you. So those of you who joined us before will know the general format of this. Today it's slightly different in that we have a program with some feedback. Someone just going to mute for me? Thank you. So yes, the format of today is slightly different from our usual in that we want to try and share with you information about how credit reference agencies work, how we could potentially use them in local government, and Colette's also going to give us some insight into what's been happening this last year regarding sort of the pandemic and changes that have affected people's behaviour. So we're really interested in your questions as always. Please use the Q&A function on the right-hand side to put your questions to us. I'll put those to the panel during the course of the presentation. Because we also have a second webinar planned in the next few weeks, I may hold over some of these questions to then as well. So if there's something really burning that you want to ask, but you think it might not be quite relevant to this presentation, but is on this topic, please do ask it. And then we will make sure that we cover it in the next session as well. The usual format with this, you can see us, but you won't be able to see each other. If you have any problems during the webinar, you can contact the moderators and hopefully they can help with sorting out whatever issue you may have. So without further ado, Colette, can I hand over to you and please take us through your presentation?
Thank you very much. So yes, I'm going to talk today around how credit reference agency data can help support local government collections. And I'm actually going to spill over a little bit into how utilities and some use cases as to how utilities have used credit reference agencies and the data from credit reference agencies to support them in their collections, because I think there are some parallels. So if we can move on to the next slide, please. So the agenda is basically broken down into three areas, and what I intend to do is pause at the end of each section just to see if anybody's got any queries that I can respond to, and we can have a general chat. So the first area that I've been asked to cover is to provide a real summary of the basics of credit reference agencies. There's a lot of terminology that's talked about in terms of credit reference agencies. There's quite a few myths. So I was going to really cover off some of the basics in terms of the governance that surrounds credit reference agencies, where we get our data from, what is the breadth of our data, and a little bit about data sharing, which is a really important component that underpins credit reference agencies. I'm going to cover that off both in terms of consumer and commercial data. And obviously I work for Experian, and so my bias is towards that, but hopefully what I'm saying is generic enough to cover all of the credit reference agencies. After covering off the basics all about credit reference agencies, I'm going to then go into some of the practical uses. I've got a particular use case for one local authority, and then I'm going to touch over into some of the utilities. And then finally, I think Experian in particular, but all of the credit reference agencies, because of the vast amount of data we have a really unique insight into both how businesses are being able to cope under the pandemic and how consumers' finances are being affected by the pandemic. And so I'm going to share some of those key insights with you. And putting all of that together, I'm going to give my summary as to what I'm seeing in terms of the data that we hold and the clients that I speak to, in terms of what I think some of the key challenges are and what the future direction will likely be for collections. So if we can move on, please, I will make a start with talking about the basics of credit reference agencies and covering off some of those topics. Next slide, please. So at a very high level, credit reference agencies, and there's a lot of terminology talked about here. It can be credit reference agency, credit bureau, credit scoring agencies. They're all exactly the same thing. In the UK, there are effectively 3 credit reference agencies. There's Experian, Equifax, and TransUnion, which was previously called Credit. We all have slightly different sources of data, but primarily we've got the same building blocks that compile the data that enables us to provide help and support for different organisations. We also, just to complicate matters, have different names for the data sources that we use, and we all have different names for the credit scores that we use. So it is quite a complicated area, but essentially 3 core credit reference agencies in the UK using the same building blocks to enable us to provide our services. From a governance perspective, so we are all licensed by the FCA, but governance goes wider than the FCA, as you can imagine, because the data that we hold, a lot of it is against consumers. A lot of our governance flows from the ICO and GDPR. And there is another body that governs the data that we hold and how we use it, and that is SCORE, the Steering Committee on Reciprocity. And that body effectively works on behalf of credit reference agencies and the wider industry to ensure that the data that we are used and the purposes for which we use it are appropriate and under an overall banner. And it's really important to think about what that banner is, because it's basically about the principles of sharing data and using data can only be used for the purposes of preventing overcommitment, fraud, and essentially crime. So when I'm talking about all of these data sources, it can sound a little bit big brotherish and it can sound a little bit concerning in some places, but actually it is for those basic principles that data is shared and used, preventing overcommitment, prevention of fraud, etc., etc. So in terms of governance, there are lots of documents, but if you've got questions around how data is used, where it's sourced, there is a core document that underpins each of the credit reference agencies, which is called the CRAN, the Credit Reference Agency Information Notice. And in that, it gives the basis under which information is shared and used and all the purposes under which we use data. One key question may well be around the legal basis under which data could be shared from local authorities with, for example, a credit reference agency. And there are some references to that in the CRAN. There are 2 potential areas: legitimate interest is covered and also public interest. It is a bit of a complex area though, so I would say individual discussions would need to be had around specific use cases that are being talked about. But anyway, really good document as a basis for information. The other one is the Principles of Reciprocity, which is managed by SCORE, and that's what defines the fact that data is shared and used for the purposes of overcommitment, and it talks about all of that. And then there is another document called the PRA, the Principles for Arrears, Arrangements and Defaults. This is solely focused on consumers. And as you can imagine, a lot of industries share data with credit reference agencies. And to even define whether a customer is in arrears is a really complicated topic. From a credit card perspective, it's quite easy. If you receive a bill and you don't pay it within the set time, then you would be defined to be in arrears. But from a utilities perspective, it becomes a bit more complicated because that bill could be estimated, for example. So basically, that reporting arrangement provides standards that everybody adheres to, all the organisations that supply data into credit reference agencies, that they will meet those standards when sharing data. So hopefully that covers off a little bit about the governance framework under which we operate. Moving to the right on the slide, we've got data sources. So there are effectively 3 core areas of data sources that the credit reference agencies use upon which to build all of the knowledge that we have. There is public data. So from a consumer's perspective, you've got the electoral roll, and you've also got such databases as county court judgments and so forth. Obviously, on the commercial side of things, you've got a variety of other different sources that I'm going to go into in a moment. But all of the credit reference agencies use the public data that is available to help build the knowledge picture. Then each of the credit reference agencies on top of that also have their own proprietary data sharing schemes. Experian's consumer data sharing scheme and one of our commercial sharing schemes is called KEYS, and that may be a term you've heard. That's the credit account information sharing service. So that, if I can just pause on that for a moment so you get an understanding of the breadth of it, from a consumer's perspective, or not from a consumer's perspective, from consumer data sharing perspective, most banks and building societies, in fact 99% of banks, building societies in this country, share information with at least one credit reference agency. Actually, 60% share information with two. And they share information every single month on all of their customers to say, are their customers up to date or in arrears on any of their credit obligations? And if they're in arrears, by how much? So it's a massively rich source of data. There is an equivalent on the commercial side, and there is another sharing program on the commercial side that I'll talk about shortly. But all of the credit reference agencies have similar data sharing ecosystems, if you like, where organisations share data with them. And then we also have acquired data. Again, data that we have purchased or we've acquired, and I'll go into some examples of those sources shortly. There are varying degrees of coverage across each of those sources for each of the credit reference agencies, and varying degrees of coverage across consumer and commercial. And I think it's fairly widely accepted that Experian has the broadest coverage across and the widest coverage across each of those data sources. But we all have our own specialities as well. So all of that information is incredibly rich and powerful. How is it used? So moving to the right of the slide, it's used for a lot of different purposes, which I've tried to summarise here. Again, a lot more detail in the CRAN document that I talked about before. The information is used to help authenticate that when you are talking to somebody, they are who they say they are, depending on which irrespective of which channel you are talking to them through. It is used to verify, and it's used to identify potential fraud. The data is also used for all credit applications, as you would expect when you apply for a mortgage. These sources are used to confirm whether you are able or likely to be able to repay that debt, or whether it is unaffordable to you. The sources are used in terms of customer management, and this can often be around identifying triggers that are potentially early indicators of consumers in particular, or businesses running into financial challenges, so that organisations can put in place early support systems for customers and potentially signpost them towards areas where they can get further help. And then, unfortunately, when customers do get into collections, the data sources then inevitably are incredibly important in terms of understanding what the appropriate action may well be, given that a customer has got into difficulty. So again, it can well be around signposting to additional support, but it's often about being able to tease out and understand whether the customer will pay, won't pay, can pay, can't pay, all of those different aspects. Another really important aspect in uses of credit reference agency data is debtor tracing. So where individuals may leave a particular residence, you want to be able to find out where they've gone, and you want to be able to collect on the debt. Our data sources are also used for vetting of tenants and staff in certain industries where that is required. And really important point is obviously our data is used across all industries. So whether it's credit cards, banking, finance, telcos, mobile phones, utilities, insurance, etc., our uses are very wide across industries and government areas as well, to help make better decisions, basically. So next slide, please. So this goes into a little bit more detail in terms of the consumer data sources that we have. So starting at the very top of the slide, I don't actually know you, I can't imagine you can see me waving my wand around, so that's a bit of a shame. We've got the KEYS credit account information system. So that's our data sharing ecosystem for consumers, and that's got about 505 million accounts on. We also, due to recent regulatory changes, have access to understand what is happening in consumers' current accounts in terms of a summary of information from a current account turnover perspective. And for that, we're able to see that information for about 100 million current accounts. And that's really useful to help understand consumers' affordability when they're potentially looking at things like debt repayment plans. We have access to all of the consumers who apply for credit, which is called our CAT system. Rental exchange is a really interesting data source. So this is where housing organisations effectively share rental information, rental payment information with us, and that can also be used to help inform decisions around consumer credit, etc., and build up a summary as to those consumers and their ability to pay and their historical, whether they have paid. So a whole variety of sources there in terms of the sharing of information and proprietary sources. And then listed in pink are some of the public data that I've talked about in terms of electoral register, insolvency, etc., etc. And on the right-hand side, some of the private data sources that we have acquired, various property data, vehicle data, etc. So to give you an extent of how often this is used and how much data is updated every month, we have roughly about 750 million records from over 600 of the largest sources in the UK updating our consumer records every month. And 60% of all credit applications in the UK provide a source for us every month. So you can imagine the richness of this data when making decisions about consumers and when they can or can't pay and what's the best way to help those customers is often found using and compiling all of this information. Next slide, please. Okay, so I said I'd touch on data sharing. Data sharing is really, really important. I've mentioned that local authorities do have some exemptions from GDPR and have access to certain data to help support them. So this does get a bit complicated, but very broadly, organisations can use a credit reference agency and are able to access 3 levels of data, depending on the information that organisations share with us. So some organisations don't share any data with us at all, but they still use a credit reference agency to be able to obtain information that we effectively source from public data and other acquired data that can be used for those purposes in order to establish the potential that somebody's going to repay debt. But moving on from that, that's where just public data is used on its own and organisations don't share data with us at all. The next level up is where the organisations share default keys levels with us. And this means that they aren't sharing all of their customer base every month and how far all of their customers are in terms of their payments. Are they up to date or are they in arrears? And if so, by how much and for how long have they been in arrears? All they're doing is sharing with us every month the their customer base and which of their customers have defaulted on an obligation. So effectively, it's the point at which an organisation may well say this is more about debt recovery than it is about an ongoing relationship with the customer, and the relationship has effectively with that customer defaulted. And there's a definition for that, but it's obviously a much smaller proportion of the base. And then organisations that share default level data with us, the whole concept of reciprocity, are able to get back out of Experian equivalent default data so they can see of their customer base which customers have defaulted with other organisations. So you get out what you put in. And then the full keys sharing level, which, as I say, the vast majority of banks and building societies do, credit cards as well. In utilities, it's probably just over half share full data. This is where an organisation shares for all of their customers which ones are 1 month behind or they're up to date. If they are behind, how much are they in arrears, etc., etc. This whole data sharing ecosystem has evolved over decades. Utilities, for example, have been sharing some level of data for the last sort of 20 years. And most recently, over the last 10 years, have started to move to full sharing. So it is a journey to move industries through each of those stages in order to maximise and fully leverage the power of the data that is held with the credit reference agency. But just to be clear, you don't have to share information with the credit reference agency to get access to everything. You just get out what you put in, but there is public data that credit reference agencies hold that do help you make better decisions, whether it's about collections or whatever it is that you're wanting to make a decision about in relation to consumers, etc. So, yep, sorry, if we can move on, please. So this talks a little bit more about the body score, I said, and what the principles are under which data is shared. Really, really important point. What is the purpose of sharing credit account information? The information that is shared underscores reciprocity arrangements for consumers. So our keys database, data is shared for the prevention of overcommitment, bad debt, fraud and money laundering. And it can't be used outside of those purposes, and it is very tightly governed for that. But I'd also just like to pause for a moment and just consider some of the benefits from a consumer's perspective as to why this data is shared. I think it's incredibly important, especially in light of COVID, and it's coming out in a lot of the regulation from Ofgem, Ofwat, Ofcom as well, that suppliers now have to be in a much better state to be able to communicate and identify their customers that are starting to financially struggle and make sure they get appropriate services in place and appropriate frameworks in place to support those customers. And if necessary, signpost them towards debt charities, etc., etc. The ability to do that is absolutely fundamentally underpinned by data sharing with the Credit Reference Agency. Because if all you can ever see is how your customers behave with you, you have no idea that they're having challenges on other accounts and starting to struggle to pay. So it's the putting together of all of that information on a customer to really understand those that need help and putting the frameworks in place that makes the whole thing really work. Also, I'd just like to bring to your attention that I think it used to be about 8 million, but most recently it's come down to just over 5 million. Consumers in the UK effectively don't have a credit footprint with a credit reference agency. And for them to actually obtain credit, they have to pay a premium to get credit because they don't have a credit footprint. They're called credit invisibles. Well, the more organisations that share data with a credit reference agency, effectively that comes down and those consumers are better able to get at affordable credit. So utilities companies, for example, starting to share data with credit reference agencies has significantly reduced that volume and enables a wider group of consumers to be able to access affordable credit in a responsible way. So the way I'd like to summarise this is it's in the benefit of both consumers and organisations for sharing of data with credit reference agencies. Moving on, please. I'm not going to go into this in detail, but just to say that the sharing of information with the credit reference agencies does go through a number of very key steps. It has a lot of rigour around it to make sure that everybody is comfortable that the data that is being shared is accurate and reflective, and the processes are heavily governed by a number of key stages and milestones. Typically, this journey can take anywhere from, if an organisation decides to share default data, it can be very, very quick. So I would say 2 to 4 weeks. If they're wanting to share full data, it can extend up to about 6 months, depending on the complexity of the data that you have within your systems and how easily that is held. But we have people who can help guide through this process if this is something that you want to do. Next slide, please. So covered off some of the consumer data sources, I'm just going to spend a moment talking about the commercial data sources. So very similar to consumer, those 3 different areas in terms of proprietary shared sources, public data, and then privately acquired data. We have got a data sharing scheme called Keys, again for on the commercial side, where organisations share every month with us all of their commercial book and how those businesses are paying against their credit commitments, or whether they are in arrears, and if so, by how much. We also have another area called the Payment Performance Scheme, which is effectively around trade credit. And what that looks at is it looks effectively at organisations that aren't paying their trade credit obligations on time, and it enables you to look at how many days beyond terms businesses are on their trade credit agreements. So really powerful source of data. Roughly that's got about 1.7 million businesses in, whereas the commercial keys has got about 19 million businesses within it. We've also got CIFAS, which is the fraud network. Moving on to some of the public data sources, you've got Companies House, obviously, Registry Trust, and a variety there you can see on the right-hand side of private data sources. And so as you can see, hugely rich, massively wide data sources that are used to help inform decisions around collections or anything else in terms of assessments on affordability, etc., etc. Moving on, please. So on the one hand, you can sit and think, well, gosh, that is a heck of a lot of information that is held. How on earth would you use that even if you had access to it? Would you be able to use it to make an informed decision about whether to collect on a consumer or whether to collect against a business? Well, thankfully, we all condensed that information down, all of the credit reference agencies, into a number of credit scores. And that's, credit scores' purpose is to use a vast amount of data, condense it down to create a score to predict a specific outcome. So on the left-hand side, I've just highlighted some of the consumer scores that are available and widely used. One of the main ones is the arrears and account management score, which is effectively a score that looks at how likely a customer is to default on their credit obligations. The next one down is consumer indebtedness score, really important score, and a lot of organisations are starting to use this extensively at the moment, because it effectively looks at, although a consumer may look okay at the moment from the credit information that you hold on them, if you give them additional credit, are they likely to be able to sustain it, or may it well push them over the edge? Could be the sort of customer, for example, who has, their credit cards up to the max, 90% utilisation. Well, actually, they may be managing that at the moment, but if you give them significantly more credit, that may tip them over into a very challenging area for them. Or specifically looking at consumers who are actually already in delinquency, what is the likelihood that they will make a payment on the debt that is now outstanding? And on the commercial side of things, again, very similar types of scores. So bedrock of a lot of the decisions that are made are around a commercial Delphi score that predicts the business failure over the next 12 months. Moving down a bit, financial strength score actually looks at predicting insolvencies within the next 12 months. And the distress warning score actually brings it down a bit earlier and starts to look at identifying the most at-risk balances within your portfolio. So hopefully it gives you a breadth of understanding in terms of the scores that are available to help you make decisions on consumers or businesses in terms of the actions that you. Next slide, please. So I'll pause there for a moment before I'll go into some of the use cases. Hopefully that gives an overview as to the data that credit reference agencies have, how we function, and some of the scores and output that we produce. Or are there any questions at that point?
Thanks, Beth. I was supposed to remind our audience that please do ask any questions that you have as we go through the presentation, and I can present those to collect on your behalf. Equally, if you have questions about broader issues around credit referencing or anything like that, again, please do add those into the Q&A, and if we don't pick them up today, we can certainly pick them up during our next session that we're planning in a few weeks' time. And just to remind you that all these slides will be sent out after the webinar, so don't worry about having to scribble lots of notes down in terms of some of the content. I'll come over to Victoria in a moment, but just a question for me, Colette, if you don't mind. Obviously, this is a framework that's been around for quite a while. What would you say to people who perhaps haven't considered use of credit referencing or the data that you've sort of talked about today before? Whereas now, what do you think has changed that means actually there's probably a stronger case for us to start thinking about this?
Well, for me, I do think that COVID provides the a real primary driver as to why people may well need to change and think about using this data, because I think everybody accepts that collections can't remain the same. People can't collect in the same way. Perhaps in the past, aggressive approaches have been used, and actually at the current time we need to provide as much support for those businesses that are struggling and for those consumers that are currently struggling. But if we look forward in terms of the potential implications of redundancies and unemployment, goodness me, it's currently at 5%, but I think in reality we expect unemployment to rise up to 7% and more. I think there are going to be a lot of people that are struggling, and I think in the fairness and best interests of everyone, the best thing we can all do is try and understand fully a customer's circumstances and make sure that we're tailoring our collections activity to where it's likely to generate a return, but also to help provide support for those people that need it. So my guidance would be at the moment that I think it's really important to use this information to best support customer bases and commercial bases. The same approach applies. And I think if people haven't thought about it using it in the past, then hopefully you can see that the use case is definitely there at the moment, given the challenges that everybody is going to be facing. And I would also say that I think some of the pain in terms of sharing with a credit reference agency a lot of that has been overcome because we've got lots of experience of lots of wide varieties of organisations sharing data with us now, and we're very good at getting them through the journey if that's a route that people want to go on. So hopefully that answers the question.
Yes, thanks, Colette. Vic, obviously, I'd love for this information to be all free, but I'm guessing Colette and the other CRAs will probably charge us for something like this. How would someone go about putting together a business case around why you should use data to actually support collections?
I think there's lots of reasons to put a business case together. So I think one of those is that in some industries, particularly local authority, you don't get to choose your customer or your resident. And therefore, I think you need to, the business cases around vulnerability, identifying very early on the strategy for those residents, those customers. So something that we used a lot in the debt collection agency world that I come from, and again, in terms of credit reference agencies and using data, that's been used for tens of years now. But it's being able to anticipate and proactively use that data to change your strategies for your customer, for your residents. And I think that's that's quite a powerful business case, not just using it reactively. But that customer, that resident is already in debt, whereby you want to trace them, or whether you want to then lodge a default on their credit file. But by using that data, what it does enable you to do is you can start to push. Certainly in previous roles, we had data pushed to us, to telling us that something is changing in their life. So, for instance, they've defaulted on their mortgage. Now, if they're defaulting on the mortgage, they are in financial. They're starting to fall into financial trouble. So, it would enable you to proactively then work with your residents in order to put them onto a payment plan or help them pay their council tax or even potentially their business rates. So I think from that's just a really powerful story that you are supporting your residents and you're proactively trying to stop them getting to that point where you would actually use the data in a different way, which is for debt recovery activity. So I think that's just one way you could do that.
Thanks for that. Claire, I'll hand it back to you, and if you'd like to take us through the next section of your presentation, please.
Yes, sure. Next slide, please. So over the next few slides, I'm hopefully going to talk a little bit more about some of the practical applications and uses of credit reference agency data. I'm going to touch on one example that is with a local authority, but I'm also going to talk about utilities. And it was interesting what was just said there, because I think like local authorities, utilities don't really have a choice of the customers that they take on board. They can't say no, they have to take on board all customers and offer terms. So they have some parallel challenges. Also, they're limited in the way that they can collect in certain ways. You can't turn somebody's energy off. You can't stop their water running. So I think some of the challenges are very similar. But what I'd like to just start with here is what I consider to be the basic components of being able to undertake successful collections. And I would imagine that a lot of local authorities are doing some of this already. The most important thing, starting at the top left, is understanding your customers. And you will have data on your own. I'm calling them customers, but you will have your information on your own residents, etc. at the moment. But for me, it's about being able to use that data and to be able to combine it with whatever external data is available that you can also use to help you be able to fundamentally understand the needs of that individual or organisation, and potentially to start and tease out such things as vulnerabilities. Moving forward to the right box in analytics, it's really important that you've got some kind of tool and capability to be able to delve into that data and analyse it. And then moving round, I think it's really important to be able to take all of that information and effectively use it to be able to drive different approaches for different groups of customers. So, for example, those that you have identified as vulnerable, you may well choose to collect in a very different way than you would from someone who you believe can pay but is potentially choosing not to. And overall, it's really important that you can link all of these areas together in order to iteratively improve. And I think these four basics underpin all of the different industries where collections is undergoing, and I also think are exactly the same for local authorities. Move on, please. So I'm not going to labour this one too much because I'm slightly conscious of time, and I'm conscious that I'm maybe talking a little bit too much. But sort of moving from the left-hand side to the right-hand side, what this is saying is there are a variety of different touch points where an individual or an organisation touches your organisation. And at each step, credit reference agency information can be used to help support decisions. So whether it is the first time that that individual or organisation touches you and says, here I am, you must have some decisions to make, first of all, to verify that they are who they say they are, and second of all, to understand whether you already know them or not, and to be able to link that data to information that you have already gained on that individual or organisation. The ability to be able to link records and genuinely understand who a consumer is, where they've come from, and enable them to link that into your existing knowledge is a really challenging area, but one that credit reference agencies absolutely excel in, because we do know consumers, where they are moving from, around, to, and commercial organisations as well. So that ability to be able to create a unique link for an individual or an organisation is absolutely paramount to being able to then provide a lot of the other services. Then moving along the bottom, to be able to potentially identify and verify the individual, and to then move on to things such as fraud alerts. So once a customer is coming on board, you potentially want to be able to understand various fraud aspects about them and to be alerted to any activity that you believe may be inappropriate or a cause for concern. And you may have various decisions to make as an organisation, such as what is the appropriate payment method for this individual, and are you willing for them to pay on X, Y or Z terms? Again, all of that and the information to enable you to make that decision well comes back to what data you hold, and a lot of the information that a credit reference agency holds can be well used in that assessment. If you can move on board to the, now effectively, if you can imagine, we've brought a customer on board and they're transacting with you. If we can move to the next slide, please. Now it's called managing the customer journey. I guess it's more when you're thinking about it, you have a potential resident on board, etc. But now they are now looking at you for a variety of different services, and you would need to be able to transact with them in some way or another. Over that course of that time, while they are potentially still paying you, it would be good to potentially be able to identify, again, fraud risks and highlight potential changes in those individual circumstances, potential indications of vulnerability, as they're still potentially paying with you, because it could be that you could reach out to them to provide additional support, or potentially even proactively offer additional time to pay things before bills come or as bills come along. And that's exactly the area that the water and energy industry are in at the moment. Their recent regulations are all about proactive identification of customers, early warning signs of potential challenges. And then sadly, moving on to the lighter pink colours, once a customer has received a potential bill and has moved into an arrears position, then a lot of the decisions change and are about, what is the appropriate means of collecting on that debt and what support mechanisms could and should be put in place for that customer, given their circumstances. Again, I hope I painted a picture that credit reference agency data can really help you understand what the right choices are to make at that point. And then moving later down the line in terms of debtor tracing and those kind of activities, and understanding whether, for example, litigation is an appropriate approach, or enforcement actions. Just making those decisions on the limited information that an individual local authority might hold could well not be as good a decision as you can make, and it may well not optimise your collections and or help the consumer in any way, shape or form, unless you are combining all of the information that you could use to make that decision. You could well end up wasting resources, etc., etc. And moving on, please. So this slide is just a very high-level summary that says that no matter which stage you're looking at in terms of a customer or a resident or an organisation, etc., it's just really important that you group together the information that you have, you understand how best you can help them, you understand when a customer's circumstances may well have changed, which could well affect their ability to pay with you. And by grouping together all of that information, you're much more likely to make a better decision. It's better for the individual or the organisation, and better for you as well. Next slide, please. So moving on to a particular case study, which is very recent, so there aren't results in terms of additional collections achieved yet, but that have been worked on with Experian and London Borough Lewisham. In this example, there were roughly about 12,500 records being passed to us, with a basic business objective that the residents, the consumers were very far in arrears, so had been in arrears for a long period of time. The business problem was that the local authorities' problem was that the the organisation had a relatively short period of time to collect, and due to COVID, the resources to undertake collections activity was significantly reduced. So the challenge was, given those challenges, how best do you use the resources that you have to collect for those customers, and also being mindful of the fact that there may be some customers who really need help rather than any sort of enforcement or collections activity. So using one of the services that Experian has developed specifically to help support local authorities, called the Debt Prioritisation Service, we've used our data and our scores to effectively allow London Borough Lewisham to segment that file and be able to understand the residents that are where the debt is highly collectible and where those customers are that are potentially struggling and actually need additional help. So roughly the top 40% of the file was where we felt that the debt was highly collectible, and that would be where the resources of the council would be best used to be able to look at collections activity. And we also highlighted at the other end of the spectrum the customers that we felt were actually seriously financially struggling, would struggle to pay, and therefore it may be better to support them through signposting to a charity to help support them in terms of understanding and prioritising their relevant debt, etc., etc. So hopefully that gives you a flavour of the sort of example of something that can be done very easily. And I would need to stand to be corrected on this, but I believe that this is an example that the London Borough didn't share data with us. This was using a service whereby we provided the data that we have without any data sharing in place, in a data sharing schemes in place. This was using the data that you can legitimately use under the exemptions of the GDPR, and that we have pulled together, as I say, a debt prioritisation score effectively to make and enable London Borough to segment the file. Moving on to the next slide, please. So I'm now going to start to talk about, in the next set of slides, a utilities example, which is actually npower. And in this, if you can move on to the next slide, please. I'd like to rewind the clock first of all, that before npower started working with Experian, sorry, if you could just move on one slide, please. Before npower started working with Experian, I don't know whether everybody else has got a screen stuck, but I'll carry on talking. To give the background, effectively for all customers that suddenly couldn't pay their utilities bill, and bear in mind, as I've said before, utilities can't be selective in terms of whether they take on board a customer, they can't really decline. So within their customer base, they effectively had, when a customer got into financial difficulties and couldn't make a payment, they had a one flavour fits all for collection. So you've probably experienced it going back some time. For those people who've been around long enough, you used to get a reminder letter number 1, a reminder letter number 2, a red letter reminder, and then various collections activity would see more stronger collections activity would ensue. And every customer who got into financial difficulties went down the same solution. Sorry, Florida, we've got a slight problem changing the slides because mine are stuck. Oh, I've now got you. Thank you very much. Yes, so every customer had exactly the same journey in terms of their collections. I think I've talked through that one now. If we can now move on one slide, please. But by working with Experian, and actually they shared data with Experian in the key sharing scheme that I talked about, they were then able to look at all the information that npower held against their customers, combine it with the massive breadth of data that Experian was able to provide in terms of whether customers were having difficulties on other credit products, use their own analytical insight, and then effectively segment all customers based on their risk, so that they were able to implement specific tailored strategies for example, customers that were deemed vulnerable. And that's really important within energy and water at the moment, because there are now vulnerability strategies from the regulators that specifically indicate what is and isn't appropriate. So, for example, for certain customers with certain vulnerabilities, you are unable to put in a prepayment meter, which is one method within utilities that enables you to recover debt. That is completely inappropriate for certain groups of customers. So the importance of being able to segment your entire customer base and treat different groups of customers differently, providing support where support is needed, but equally being able to collect on debt where customers can afford to repay debt. And where that is identified and a potential deficit builds up, then it's really important to be able to understand a customer's ability to be able to repay that debt and set up a repayment plan that is affordable to them. So within this whole infrastructure that was put in place, and that's making it sound grander than it was, but it's basically just the use of those 4 boxes that I talked about at the start of this section. By being able to implement that approach, NPAL was able to deliver considerable benefits. If we can just move on to the next slide. Not only were they able to improve customer satisfaction, which was assessed on an ongoing basis through various surveys, but also they actually improved the debt that they were able to collect. They improved their collection rates, and they were able to reduce their overall bad debt charge and losses. So when they first implemented the system, they were able to make an improvement of a 20% improvement in their bad debt charge, moving on to an 8% annual improvement thereafter on their overall bad debt charge. So they were able effectively to reduce their bad debts, collect more, and improve customer satisfaction, because they were tailoring the approach they were using towards different groups of customers. Another key benefit for them was the fact that they were able to implement changes very, very quickly to the systems that were given to them, typically 48 hours to implement a change. So, for example, to execute an email and send it out to a certain group of customers to advise them of a certain, not change to terms and conditions, but a potential additional service that would be available to help them with payments, vulnerable customers, etc. Absolutely great for them, and I'm sure that improved their customer satisfaction as well. So hopefully those slides, if we can move on to the next slide, please. I think that might be the last one in terms of the use cases. Hopefully they give you some examples of the types of use cases as to where credit reference agency can be used. Obviously there's the one with the local authorities, but also the utils. One thing I would like to say as well is really, really interesting over the last few months since COVID is the use of open banking. And it's a bit of a challenging area to cover quickly, but effectively open banking gives consumers the ability to say, for a particular purpose, they will share their summarised bank account information with an organisation. What's happened due to COVID is a lot of organisations, and especially utilities, are starting to use this so that when a consumer gets into debt, they have a conversation and they say, well, we'd like to set up a debt repayment plan. We'd like to understand what an appropriate or an affordable amount would be for that debt repayment plan. The best way of assessing that is being able to understand what the consumer has in terms of incomings and outgoings every month. That whole area is suddenly seeing massive jumps in utilities, and I think there are potential applications for local authorities as well. And one of the reasons I think a lot of utilities are piloting that at the moment is because it's very easy to get up and running. It's not high tech, it's not high cost. Well, it is high tech, but it's not high cost, and it doesn't require a lot of infrastructure to implement it. It's an email with a URL link on. So, and that again has the uses of credit reference agency data in it. So hopefully that summarises the various use cases that credit reference agency data can be used. And I will pause again in case there are any questions and in case Farag wants to ask any.
Well, we have a very quiet audience today, so we have to come on, guys, wake up and give me some questions. It'd be great to ask our experts here. Can I ask? I was struck by something that.
Can I ask a question?
Yeah, sure.
It's for Claire. I suppose for me, it's the practicality and the technical aspect to this for local authorities, and that's around the reporting requirements. How easy is it for a local authority to get this up and running with experience to start that reporting?
Well, in terms of the very simple use case that the county council, I think it was Lewisham, I've forgotten the name of it, my head's moved on to the next set of slides. It's really, really easy. It's a batch process where we basically had the 12,000 consumer records that they wanted to send over. We appended our data, we handed it back with guidance as to how to best use it in terms of the approach they may want to take. And at its most basic level, without getting into data sharing, it is as simple as that. If it becomes the case that you want to do that sort of thing on a more regular basis, or you may want to tailor your approach, things can get more complicated, but it can be at its most basic level very, very easy. And I believe that whole process was set up very quickly. So I don't want to, if I have over-engineered it to make it sound complicated, I don't mean to. There are a whole spectrum of ways of approaching it.
Thanks, Vic. Any more questions? Vic? No? Okay. Let me, if I might come to one, I was about to say, I was struck earlier by a point that Vic made, which is something that I always hear when I'm talking to clients in all organisations, which is, how do you get ahead of the game? How do you get ahead of a collections curve? How do you become proactive rather than reactive? How do you get there before the next creditor, which is often the other sort of challenge that we often find. With those two examples that you showed us there with both Lewisham and with Empower, how do you think those sort of examples enable those two organisations to actually get ahead of a challenge rather than simply reacting to the situation that they're facing?
Well,
how
I think it's twofold.
Become proactive.
Well, yeah, and I think it's twofold. I also think my final slide on this hopefully summarises that. But I think what it enables you to do is, although, as I've said, a customer, if we stick with consumers for a moment, you may think the consumer is absolutely fine. They're paying their bill with you. You have no clue that actually on their credit card, they're suddenly going up and starting to pay interest. And you can't see the challenges that individual customer that you have is having elsewhere. So I think the ability to be able to move from being reactive, or they haven't paid a bill and therefore I am going to take whatever action is appropriate, to, on my entire customer base, I can use a whole set of triggers to identify customers that are having challenges elsewhere and therefore proactively reach out and say, whatever that conversation may be, if you are having financial difficulties, would you like to have a conversation? Or, there are a variety of debt charities that can help support you. Even putting that on the bottom of bills, I think, can help you move from a reactive to a much more proactive approach. I think there are another key aspects that are coming with technology now, which hopefully I'll go on to in my final slide, where I think people can get more on the front foot in terms of a more proactive approach. So rather than waiting till consumers get into arrears, and perhaps those arrears build and they go through some collection stages, actually at the first sign of financial challenges, you're having an assessment of that consumer's ability to genuinely be able to pay and genuinely understand, if they can, then what is affordable to them, and make sure that works and is going to work, and as opposed to allowing a problem to build and get much worse. And I think some of the technologies allow you to do it, like open banking, I think is really helpful getting on the front foot. Slightly conscious of time for it. Should I go into the next few slides?
Yeah, please do.
Sorry. So I think credit reference agencies are really in a unique position, especially during the pandemic, because we have masses of information on how consumers are, weathering the storm of COVID and how businesses are. So I just wanted to spend a couple of minutes talking about that, and then moving on to Farad's point there, in terms of what that means in terms of challenges and future direction. Next slide, please. Oh, but before I do that, actually, really important, I think we've touched on it a few times, so I'm not going to labour it too much, but for me, one of the huge emerging challenges is the importance of understanding vulnerability. It is now being a significant factor in all of the regulators in terms of how they want organisations to treat customers. Most of them have got a vulnerability strategy, and I just think it's really important in the consideration of any collection strategy. I think even prior to COVID, vulnerability was an incredibly important topic. And just to recap a moment, what do we mean by vulnerability? Well, there is now a common acceptance of a definition, slight variations, but that it is consumers who are, due to their circumstances, particularly susceptible to detriment. And under that, as you can imagine, there are a variety of different categories. You've got to consider mental health, physical health, accessibility to services, literacy skills, etc., etc. So on the left-hand side of this slide is how we understood vulnerability prior to the pandemic. Obviously, since the pandemic, there are so many more customer groups that are potentially going to be vulnerable. be it those that were told to shield, or those that are on waiting lists for cancer, or those that have been directly affected by COVID and potentially long-term COVID as well. But the biggest area for me on vulnerability is how many customers are going to be pushed to the financial limits and will struggle to pay. And it's groups that have never had it before, whether it's businesses, some businesses could be considered vulnerable because they're servicing vulnerable customers, but particularly for consumers, there are going to be consumers who've never had difficulties before, and they're going to be facing them now, and they're going to be embarrassed by them. And we've all got to be able to help support these customers, because we're going to go through a really challenging period over the next year and beyond. So I think vulnerability is incredibly important to talk about, and I think credit reference agency data can help you particularly identify people that are starting to financially struggle. Moving on, please. So going back to the insight side of things, what have we learned from all of the data that we have? So about 50% of individuals have suffered a change in their income over the COVID period, which is quite substantial, but not necessarily an alert, because actually some consumers have been incredibly savvy and credit card balances, surprisingly, have reduced by about 10%. But if we factor into that unemployment, as we've talked about, 5%, we expect it's more like 7% and potentially rising. Consumers are going to struggle going forward. We've got 27 million have been given interest-free overdrafts, and 1.8 million are on payment holidays with mortgages. I think overall there's about 4.5 million have got payment holidays with credit cards, loans and mortgages. And what we can see is what's happening as those payment holidays are ending. And sadly, as we could all probably predict, as those payment holidays are ending, consumers are rolling off payment holidays that were offered and insisted on, rightly so, by the FCA, and the arrears are significantly above the levels we would have ever expected. So between 3 and 8 times the levels of arrears as you roll off payment holidays. I think when you think about the fact that the consumers who've got payment holidays roughly have about 26 million out on other accounts, of which 2.3 million is already in arrears, we can start and build a picture that from a consumer perspective, the pressures are building. It's a really, we knew it was coming, and it's just the tip of the iceberg, really challenging. If we move on to the next slide, which summarises the position from a commercial perspective, and commercial insights, what we can see again is a really challenging picture, and it's only just starting to emerge. About 30% have got commercial organisations have got less cash flow in comparison to 2019 for the hardest hit sectors. We can see that people are and companies are starting to pay their bills later, about 25% later, rising to 50 to 60% later in the hardest hit areas. Down the right-hand side, insolvencies have remained fairly low due to the inability and processes to be able to move them forward, but actually they've started to tick up in December. And you put all that together, also we've got a massive raft of new businesses that are all being set up as individuals are being furloughed and turning to potentially set up with small businesses. We've got a 13% rise in those. So overall, is the impact and the potential storm here for financial difficulties across both consumers and commercial organisations is a picture that we have to consider when moving forward into collections. So I think it's the final slide, please, if we can move forward. What does all of this mean? Well, sitting back and talking to organisations about their challenges and what I know about the technologies available, I think there are 4 key areas that all organisations really need to be thinking about. It is the speed of change. Could you easily implement a change to your collections processes to change what you're doing, to either to provide more support for potentially vulnerable customers, or to adapt the timings between certain collections events? Could you do that? Because if you can't, I think organisations are going to struggle. Can you use digital and self-service to its best effect? So are you using self-service capabilities so that consumers or organisations can actually speak to you digitally and potentially look at things like debt repayment plans without taking up your resources, especially when they're lower risk? Vulnerability, I've talked about. Are you incorporating vulnerability in your processes? And if not, why not? Because I think that's going to be incredibly challenging. And the final one is open banking. Are you using open banking? Would you like to know more about it? I'm very conscious I've talked about that one very quickly, but happy to take questions on it or talk about it in the future if that would be useful. And where I've talked right up to the max, apologies.
Okay, thank you.
Much,
well, what we might do there is we had some. Thank you very much for that. We had some questions right at the last minute, but we'll hold those over to the next session. So some really exciting issues that we picked up there. So I can thank both Vic and Colette for your contributions today. We'll notify you of when we plan to do the next session, hopefully in a couple of weeks' time. And the idea is that we're going to take some of this, the basic sort of underlying concepts that we've put across today, so the understanding we've got today, to delve more deeper into how we can practically use this information to actually improve collections within specific local authority contexts like business rates, like council tax, where it's slightly different from a normal commercial environment. So thank you everybody for joining us today, and apologies we're slightly late on the running. You will get a survey at the end of this session, so please do give us your feedback. It's always helpful for us to know what you like and don't like and how we can improve. And I look forward to you joining us in the near future. So thank you very much.
Thanks, everyone.